a lot of drift again after Fed Chair Jay Powell's punchy 8-minute Jackson Hole speech that tanked the equity markets. His message very clear to U.S. and households and businesses. The Fed's job not done on inflation. You're seeing Fed funds futures now, Akiko, pricing in a 66% chance of a more aggressive 75 basis point hike in their next meeting in about 3 weeks. That is different than the 50 basis points that they had been pricing in prior to the Fed speech on Friday. A lot of market movement just over the last two business days.
You get the sense that Jay Powell was looking at the market moves, not on Friday, but before that, saying, I need to just come out it and just put it in blunt words here. Because to your point, I mean, this is a speech that usually is about 20 to 30 minutes. This was much shorter. And it was really to the point where he said, we're not done and we're not going to take our foot off the pedal until we are. I mean, really clear terms. And it's interesting to see the market reaction because you could argue that this is sort of what the messaging has been from the Fed. But in many ways, the market had interpreted after the last meeting to say, well, you know, maybe inflation had peaked. Maybe there will be cuts coming next year. And this was the Fed chair essentially coming out and saying, look, you're running way ahead. Our focus right now is 100% on inflation.
Way ahead. And, you know, for what's worth, I was on the ground there in Jackson, and everyone was astonished by how short and how direct and to the point the Fed chair was in those remarks. And what's also interesting is that from the media standpoint, there's a lot of interviews that usually take place. Not as many Fed officials, if you notice the docs that we had on Yahoo Finance or other media outlets as well.
You mentioned it going into the meeting.
And that may have been deliberate. I don't know behind the scenes if there was any sort of coordination there, but it was certainly the case that you didn't have as many people speaking as you usually hear from during previous Jackson Holes because maybe they wanted the focus to be on Jay Powell. But of course, that doesn't mean we didn't have any interviews. We had the chance to speak with Cleveland Fed President Loretta Mester, who similarly said that the rate hikes will continue, reiterating the chair's point that there could be some pain. Take a listen to what she told us on Friday.
Well, I believe that we're going to have to get interest rates up probably a little above 4% by sometime early next year and hold them there. I don't have a recession in my own forecast for the economy. I do think growth will be below 2%, which is my trend rate. And I do believe the unemployment rate will go up, you know, to a little bit more than where it is now, to 4 to 4.25%. And that's going to be painful for the people that affects. But the alternative is also very painful.
A noticeable change in tone, Akiko, from the last Jackson Hole meeting, which was virtual, where the Fed chairman was saying all this inflation is going to be temporary, it's going to be transitory. That clearly did not age well. Now you have Fed officials talking about pain. It's not something that you really want to hear.
Well, it'll be interesting to see come Friday, you know, how the market interprets the job numbers. I mean, the expectation here is that you could have another strong print, but that's necessarily not a good thing because if you listen to what Jay Powell said on Friday, I mean, it really is the idea that unemployment will probably have to tick higher. He said Americans will have to experience pain. If you counter that with the jobs numbers, I mean, it will be interesting to see how the market interprets that.
And Loretta Mester had said in that interview that she expects to see the unemployment rate go up to maybe 4 or 4.25%, which is not as bad as the unemployment rates that we've seen in previous hiking cycles, but that would still be millions of Americans getting put out of a job compared to where we are now, which would be pretty catastrophic. You know, I mean, it's something that would definitely be noticeable as well. But again, you know, somber tones coming out of that Fed meeting. But I guess if the overall concern is that higher inflation is even worse, then that's what they want to do. And that's their MO.
And it's hard to say that, you know, higher unemployment is a good thing because to your point, people are going to have to lose jobs as a result of it. But really, when you think about where inflation is and where the Fed believes that things need to go in the labor market, that really comes down to that's what we're looking at.